So when you apply for a home mortgage, you're going to need to sign a bunch of disclosures and documents as part of the process. The most important document of the upfront disclosures is going to be something called a loan estimate, or LE document for short. In today's lesson, I'm going to go through the entire loan estimate document, break it all down for you so you know exactly what everything means. Hey, it's Robert Weinberg, and on this channel we empower people to take control of their futures through expert mortgage and financial strategies. In today's video lesson here, I want to go through and demystify the loan estimate document. So you're going to get this huge package of documents either in the mail or more than likely by email for electronic signature, and it's going to have probably at least 50 to 100 pages in it. A lot of the documents are just normal government disclosures, but there's one document in particular that I want to focus on. It's probably the most important document in the entire RESPA initial disclosure package that you'll get within 3 days of making an application for a home mortgage. Doesn't matter whether you are buying or refinancing a home, this is something that you're going to get at some point in that process. So I want to go through the document with you. I want to explain all the different parts, what to look for, so that you know exactly what to expect. All right, so it's a standard form. This loan estimate is a standardized form. So everybody, all mortgage companies have the same protocol. This is a standard template that they use. So at the top here, it's going to have your lender name and it's going to have their address. Okay, it's going to say loan estimate on it, and then it's going to show the date they issued it, your name as the applicant, the property address. In order to get this estimate, you do have to have a specific property that the loan is going to be on. So if you're just getting pre-approved for a mortgage and you don't actually have a specific house yet that you're buying, then this will not be something that gets issued. At the point when you actually have a subject property address, that's what starts the clock of issuing this within 3 business days. Now, the property value, typically when you get this, is just going to be an estimate of what the value is because we may not have an appraisal back or that sort of thing. So this will show you what the estimated value is going to be here. Now, on the right-hand side of the top, it's got the loan term, 10-year, 15-year, 20-year, 30-year. It's got the purpose of the loan. In this example, it's a refinance. If you were buying a home, it would say purchase. It's got the type of product you're applying for. Okay, this is very important. You want to make sure if you're expecting a fixed rate, you want to make sure that you are getting a fixed rate. If you're getting an adjustable rate, it will notate that here. And then the loan type. So it could be conventional, FHA, VA, USDA, or any other type of loan. Those are the most common. It'll have an X on the box that the type of loan is. The loan ID number, this is just an arbitrary number that every loan is going to have to identify itself in the system of your lender. Some lenders use 4 or 5 digits, some use 15 digits, or anywhere in between. Don't get too worried about your loan ID number. And then the rate lock. This is really important because a lot of mortgage companies, they'll tell you, oh, we're getting you, a 2.9% rate. But if this says no under rate lock, then your rate is not locked in. At the point that your rate is locked, they will issue an updated loan estimate to you where this will be checked yes. Okay, so depending on your mortgage company and your loan officer's protocol, they may or may not have your rate locked up front. But if they're telling you you're locked in and this says no, then this is what the actual numbers are that are going to underwriting on your loan. So make sure to question them on that. Again, you'll receive a new copy once your loan is locked saying yes. Now moving along down here, the loan terms. So the loan amount, this is the total amount of the loan that you're getting. If you're refinancing and rolling in closing costs, this amount will include the closing costs. If you're getting cash out, consolidating debt, that sort of thing, then this will also include those figures. If you're buying a property, then this will just be a straight percentage of the property that you're buying or of the purchase price. Now, important thing here on the right-hand side is, can this amount increase after closing? So this is going to tell you whether, in this case, can your balance go up after closing? Can your interest rate go up after closing? Can your principal and interest, can the monthly payment fluctuate? Okay, for most people, it's going to be no on all these. All right, interest rate. What are they telling you on the phone versus what is on this paperwork? Again, the paperwork doesn't lie. So if this is anything different than what your loan officer discusses with you, you're going to want to talk with them about that. Question it. Okay, if it says yes under interest rate fluctuating or increasing, then you probably don't have a fixed rate mortgage. Again, something you want to understand or question. Monthly principal and interest. So this is just the mortgage without taxes and insurance. And that amount should not increase after closing on a fixed rate mortgage. It would only do that on an adjustable rate type of loan or a negative amortized type of loan, which most of the time are not available right now. Also, prepayment penalties and balloon payments. So if your loan has a prepayment penalty, it will say yes there. Prepayment penalty is, can you pay extra on the loan without being penalized? If you want to send in a $50,000 or $100,000 prepayment, can you do that without being penalized? So you want this to be no, to give you flexibility. And same thing with balloon payments. So the way a balloon works is that at some point during the loan, they're going to make it full, due in full. Really, I don't see balloon payments very much anymore. So if this says yes, it's something you're going to want to question. It's something to be concerned about, because you don't want a balloon payment. It can put you in a very difficult circumstance. And if you are getting one, know what you're getting into. Talk to your loan officer. So moving along down this document here to projected payments. So this is where you're going to see for the first time the total payment. That's going to be the principal and interest. This should match this amount right up here. Then your mortgage insurance. This is the same as like PMI. Okay, if this has an amount there, it means that you have mortgage insurance, like on an FHA loan, for example, or on a loan where you're buying or refinancing and you do not have 20% equity in the home. This will have an amount there for mortgage insurance. And then your estimated escrow. So this is typically going to include both property tax and insurance. Depending on how your loan officer structured the loan, it may include only insurance or only taxes. But for most people, it's going to include both if you're escrowing. So this is going to be the amount for both property tax and insurance in this case. And this is the total. So if you add up these three lines together, this is your total estimated monthly payment. Now again, this is a loan estimate. This is given in early in the process typically. So don't be surprised if these numbers go up or go down by a few dollars once your loan officer and mortgage processor verify the property tax, insurance, and other things that are involved in your monthly payment. Here, where it says estimated tax, insurance, and assessments, it's going to show you the breakdown of what's included. Okay, so if it only included taxes, then insurance here would say no. If it only includes insurance, then taxes would say no. In this example, it includes both taxes and insurance, so it says yes on both. If you're buying a condo or a property that has a homeowners association or HOA fee, then it will reflect in this total amount. Even though it's not included in your mortgage, it will reflect here. It'll say other homeowners association fee, and under in escrow, it will say no. You never have I seen where you actually can escrow for the homeowners association fee. Okay, so that gives you the lowdown on the projected payments. Next is this costs at closing. This is a very important section. A lot of people have a lot of confusion on this section. So don't be surprised if this estimated closing cost number is way more than you're expecting or way more than you have anticipated. And the reason why is because the way the government makes this form is they roll together, okay, the mortgage loan costs and other costs like escrows, taxes, insurance, premiums that have to be paid, and prepaids that have to be paid to set up your escrow. So this amount, again, can be a lot higher. Typically, when people say, what are my closing costs? They're talking about this number right here, the loan costs, which are like your mortgage fees, lender fees, and title fees for the attorney or title company, which we'll go through here in a second. If you're getting a credit from your lender, then it will show it here under lender credits. And it will subtract that from that total, and that will all show here, okay? Estimated cash to close. So if this is a negative number, that means you're getting money back at closing. Again, this is an estimate. In this case, this client, they asked for $20,000 in cash out. So the way this loan was structured is the loan estimate shows they're getting back $21,492, okay? Now, if this was not a negative number, if this was a positive number and that negative sign wasn't there, then that's money that you actually have to bring to closing or write a check or wire transfer for the closing. This is going to be more relevant when you're actually either paying closing costs out of pocket on a refinance and or when you're purchasing a home and you have to pay down payment and closing costs out of pocket in most cases. So that will give you a good idea of how much money you actually need for closing. Now we're going to break down the closing cost details. And this is a really important page because it's going to really give you a lot of the details on these numbers that we just talked about that are encompassed in this estimated closing costs. So let's start here on the left-hand side under loan costs. Now I'll start by telling you that every lender is going to have different loan costs. Some lenders will have no loan costs and charge you a higher interest rate. Other lenders may just have a flat origination fee of $1,000, a couple $1,000, and that encompasses all these different fees that are involved in the mortgage process. Administration fee, that's a fee that will typically go to the actual mortgage lender back office for them administering the loan process. The origination fee is something that is charged to originate your loan. It's usually going to go towards a commission that the loan officer would get, or depending on how your loan is structured, towards points. Now let's talk about that. So up here at the top, the first one is percentage of loan amount, points. So if you've elected to buy your interest rate down, then it would have something filled in here for points. In this case, they did not buy the rate down using points. Processing fees are the loan processing that needs to be done. It's usually going to be anywhere from $500 to $1,000 in most cases. And then underwriting fees are fees that will go to the underwriter on the loan for them doing the underwriting. So it's typical that the lender fees, excluding origination and points, usually are going to be somewhere between $1,000 and $2,000. I would say average probably $1,600 on total lender fees. Again, could be less or more. Every lender is different. Get an explanation from your loan officer on these if you have questions. Section B is going to be services you can't shop for. So it's going to be your credit report fee, document prep fee to go to the law firm that actually preps the document at your lender's office. And then if there's an appraisal or final inspection, land survey, that sort of thing, a lot of the time that will show up either in Section B or C. Appraisal will pretty much always show up in Section B. If your loan requires an appraisal, that will be there. And then Section C, services you can shop for. This is where all the title and attorney's fees are going to show up, because you have the ability to shop for those. You can use any title company or attorney that you would like. Just notify your loan officer as early in the process as possible. Usually the initial loan estimate is going to give you an estimate based on a local provider, as I'll show you in a minute, that they've just chosen to get an estimate of the fees. Okay, courier fee is going to be a fee for them sending out documents by like overnight mail. Lender's title insurance is going to be the money that insures the lender and that their loan is going to be made good on the title. Municipal lien fee is a fee that's charged for them to get the tax information on the property from the town or city that you're buying in. Recording fee to record the mortgage and documents. Release of lien fee if they need to have a mortgage discharge or the mortgage that was on the house previously released. Settlement fee, so a lot of companies will just take a lot of the fees I just told you about and they'll lump them all in and charge you a settlement fee of $750, $1,000, or a couple $1,000, depending on your state and what provider you're using. That's the actual closing fee. So that's what they're charging you to actually do the closing and the paperwork for the closing. Title examination is the fee for the title company or attorney to actually look over the title and review the title search, make sure everything is on the up and up, there's no clouded title, there's no unreleased liens or things that are not aware to you as the buyer or homeowner. And then wire transfer fee. So there's always going to be, especially on a refinance, a fee of them paying off your current loan. They're going to need to send a wire transfer to do that. That could range anywhere from maybe $50 to $100, depending on your provider and their bank. So those are the fees on the left. Those are the loan costs. So when people talk about what are my closing costs, 9 out of 10 times this is what they're talking about, are the left side fees here. Okay, so in this case, the total fees were $5,491. All right, now other costs. On the right-hand side, these are costs that pretty much no matter what lender you use, everybody's going to be the same on these costs. These are your recording fees, okay, from the town or city to record mortgages and different things that have to be recorded onto the title with the town. Transfer taxes. If you're in a state that charges transfer tax, this is where it's going to show up. The prepaids are going to be prepaid interest from the day you close until the end of the month that you're closing in. And then if you're paying a homeowner's insurance premium, mortgage insurance premium, or a property tax installment, that's going to show up in this section F here, okay? Section G is going to be the money they're collecting towards your escrow account. This is going to be completely different based on the exact date you're closing, when your property taxes are due. Are they due monthly, quarterly, semi-annually, or annually? Every state is different. And then your insurance. When is your insurance renewal? If you're escrowing your property tax and insurance, there needs to be enough money collected here in order to make good when the renewals happen, when the payments have to be made. So this can be a substantial amount. These are what I call escrow deposits. This is money you're depositing with your lender in order for them to have enough in there to actually go forward and make the payments when they're due, so you don't have to worry about them. If you choose not to escrow taxes and insurance, then this will be zero. There'll be nothing collected in Section G whatsoever. Okay, so what they do is they take the total loan costs and then the total other costs, and they add those together, and then that's where they come up with the total closing costs. So you can see it can be a little misleading because the things on the right-hand side, I and most of my clients don't really consider those closing costs. Those are going to be the same no matter where, and that's your money, specifically the taxes and insurance that have to be prepaid and deposited with your lender. So don't get too worried or wrapped up if that number is a little higher than you expect, especially when you break it all down and look at where the money's going. You'll notice most of the time the prepaids could be half or even more than half of the total closing costs showing there on page 1. The government, again, requires that that all gets lumped together into that total closing cost figure. If you're getting a credit from your lender towards closing costs, it will show up here under where it says lender credits right here on the right-hand side. Okay, and then it's going to show how they calculate the cash to close, the closing costs, if you're rolling it into your loan, and then money that you're getting back at closing. Again, in this case of a cash out refinance, the borrower is getting back $21,492, hence the negative number. All right, so just to wrap up this lesson here, additional information about this loan, we'll have the lender info in the upper left. It'll give you some comparisons about how much money you'll have paid to the loan total over 5 years, and then how much you'll actually pay towards principal over 5 years. Your annual percentage rate is going to be the total cost of the loan. This is not your interest rate. The APR is something that will encompass the loan cost and your interest on the loan and lump those together into a total cost. So you can see, like in this case, the interest rate is 2.49, but the APR is 2.714. That does not make a difference on your payment, so don't get too worried or wrapped up in the APR. It's a very difficult, and in a lot of cases, a calculation that can be manipulated by the lender. But if you're comparing two loans side by side, and you want to just easily compare, then the APR may be somewhere at least to look at side by side to see what you're getting as far as getting the best deal on your loan. The total interest percentage is the total amount of interest you'll pay over the entire term of the loan, in this case a 30-year loan, as a percentage of your loan amount. Okay, so this can be a huge number. That's not your interest rate. Again, it's the TIP, total interest percentage, over the entire term of the loan. All right? Other considerations. Ordering an appraisal, it talks about here. If your loan can be assumed or not, meaning someone taking over. Most of the loans that are made today cannot be assumed. It's required that you have homeowners insurance. If your payment's more than 15 days late, there'll be a late fee. Every state is different. This will show you how much the late fee will be. Liability after foreclosure explains that if you do a short sale or your home gets foreclosed upon while this mortgage is on it, and they don't sell the house for enough to pay off the mortgage, then you may have liability. There may be a tax liability that you have after the foreclosure because they didn't pay the loan off in full. This happens a lot with a short sale, specifically if the house that you're buying or refinancing goes into short sale, you may have that tax liability. It talks about that here. Refinancing this loan will depend on your future circumstance, your future financial situation, the property value, and market conditions. Even if your lender insists, oh, you can refinance in a year, you can refinance in 6 months, this disclaimer right here is telling you you may not be able to refinance in 6 months. What if your credit goes down? What if your property value, your area, the values go down, you don't have enough equity to refinance? And there's any of those circumstances could happen, and even if you have all the other criteria, you may not qualify to refinance, so understand that. And then last but not least is servicing. This will show whether your lender intends to actually service your loan on the books in-house or if they'll transfer the servicing. Most loans today, I will say, are transferred at some point, so you'll probably see this say that it will be transferred. Understand that if your loan is transferred, it's just the name that you're writing on the check or online bill pay. It will not change the actual terms of your loan, like the interest rate, the fees, or anything like that. And when you actually sign this loan disclosure, the loan estimate here, you're just confirming receipt. Okay, this is not a contract. Like it says here, you do not have to accept this loan because you've received this form. It's just confirming that you got it for disclosure purposes, for RESPA purposes. Last page here of this disclosure is going to be additional services, or excuse me, additional details for services you can shop for. So earlier on, we talked about Section C, services you can shop for. This is where it's going to break down the provider that they've identified, and it's usually going to be based on zip code or someone that your lender's done business with before that does these services. If you're getting a survey of your property, a land survey, it will be listed in here. If you're getting a pest inspection, it will typically also be listed in here. So again, this is just a provider they've identified. You can use any provider that you want in that section. If you have your own attorney, if you have your own land surveyor, pest inspector, any of that, if it's required, let your loan officer know early in the process that you want to use your provider so that they can get with them and communicate and whatnot in order to move forward and make it a smooth process for you. I really hope that this video has been an insight for you. I hope it's given you a lot of good information, a lot of detailed information that others may not be sharing with you about this very important document, the most important document in your loan disclosure package, the loan estimate. If it's your first time watching us here, go ahead, hit the subscribe button, hit the bell so you get notified on all of our future content. If I can be of assistance to you or anyone that you know, I like reviewing documents with all my clients like this. I'm licensed in Connecticut, Massachusetts, and Florida. If this is the type of service you like, hands-on and detailed, feel free to reach out to me. You can contact me by private message, you can text me, or you can email me directly, okay? Also, my phone number, all my contact info is here and throughout social media and on the internet, so feel free to reach out. Again, hope it helps. We'll talk to you soon.